Over the last 3 months, Nifty has fallen around 10% and mid-cap and small-cap index are also showing a lot of volatility with many individual stocks down 20 to 30%. So there's certainly some panic in the air. Here the most important question is, what should you do with your portfolio in this situation? Sell everything, hold, or buy more? Hey everyone, my name is Sahil and this is my Personal Finance Academy. Over the last few years, the Indian stock market has created a lot of wealth for the investors. Let's accept it. We are all now used to 30-40% return on a yearly basis. Especially the investors that started their journey post-COVID have not seen a major correction. Hence, even a small volatility creates panic situation. That's where, in today's video, I'll discuss 5 practical strategies to protect your portfolio during a market crash and how you can successfully handle the volatility in the market. So whether you are a beginner or an experienced investor, I'm sure this would be a worthwhile watch. Alright, let's get started. So the first strategy is to have a clear understanding of the difference between a crash and a correction. Because there's a lot of misconception in our understanding of what is a crash and what is a correction. Today even a 5% dip is called crash. But remember that stock market always moves in a cyclical manner. It sometimes goes up and sometimes goes down. However, the fact is, in the long run, stock market always goes up. This chart of Sensex shows the growth from levels of 560 in 1996 to now at nearly 80,000 levels. That's 145 times growth in last 38 years. But if you look closely, it was not a smooth journey. There have been many cases where Sensex has corrected more than 30%. That include Harshad Mehta scam, dot-com bubble, 2008 financial crisis, and then COVID. And there are many instances when Sensex tanked around 10 to 15% or more. I mean, we have seen crazy events like war, scams, catastrophes, change of government. Yet Sensex has generated 145 times return in last 38 years, which is around 13.5% CAGR return. And I believe that we can continue to fetch a 12 to 14% return for at least the next couple of decades. Just to give you an idea, the same amount if kept in FD would take 15 years to double, considering a post-tax return of 5%. So this volatility is the price we pay for the great return stock market generates. If it was that easy to fetch 13-14% CAGR return without any risk, nobody would have invested in FD, right? So please be very clear, 10 to 15% correction is not a crash. In fact, every correction in the market creates amazing buying opportunity. For instance, during COVID, Sensex tanked from levels of 42,000 to levels of 27,000. And from those levels, it zoomed to nearly 80,000 levels. Likewise, every correction makes the valuation attractive to buy at lower level. And those who utilize the correction and invest more, they end up generating much higher returns. So make sure that you clearly understand what is a crash and what is a correction. Last crash we witnessed was during COVID. Since then, we have seen small corrections here and there, and they will continue to be a part of the investment journey. Every 2-3 years, you can expect 10 to 15% correction. Those who panic from the correction will lose money, and those who utilize correction will make money. Second strategy to manage volatility in the stock market is diversification. Let me give you an example why diversification is important. So 2022 and 2023 were the years that witnessed extraordinary growth in defense sector, railway, PSU sectors. And the fact is, majority of retail investors end up chasing returns. Let me be very honest. So obviously, a lot of people ended up having a very high exposure in railway, defense, PSUs in 2024. However, there's a sharp correction in these sectors in last 6 months. Nifty PSU Bank is down around 20% versus Nifty correction of 10%. Then many defense stocks have corrected 20 to 40%. There is a defense mutual fund launched by one fund house at the peak of its hype and is down more than 20% in last 6 months. Likewise, many railway stocks have corrected 20 to 40%. So those who ended up having very high exposure in these sectors have felt the biggest pain in last 6 months. That's where the key is diversify and have a proper asset allocation as per your risk tolerance. For instance, you have equity as an asset class where you can further diversify across your large cap, mid cap, small cap, as well as across sectors. Here you can consider both equity mutual funds and individual stocks. But if you are someone who does not have a lot of knowledge about stock picking or does not get enough time for research, I would suggest having higher exposure in equity mutual funds. Otherwise, you can also explore my weekly video series where I share my own investment strategies, stocks that I am adding or selling from my portfolio along with proper reason behind the decision. I also track more than 200 quarterly results that really helps in identifying investment opportunities. But let me be very clear, this series is only for those who want to create wealth for long term by investing in fundamentally strong business, not for those who are looking to make quick money from stock market. For more details, you can explore my website or join button of this YouTube channel. I'll provide the link in the pinned comment. The next option for diversification is debt instruments like debt mutual funds, bonds, or even fixed income instruments like FD. Then you have gold that acts as a great hedge against inflation and currency depreciation. In fact, data says that in last 5 years between March 19 till 24, gold has even outperformed Nifty. So you can consider keeping some money in gold as well. On top of that, you can also consider having some international equity exposure in countries like US. That way, you can nicely diversify your portfolio. Please note that here the key is to understand your risk appetite. The problem is, people completely ignore the risk part and have very high exposure in high risky assets like exposure in a specific theme that we have discussed initially, or having exposures in even cryptos. Everything looks great when there's a good return, but I always say that it's not just about returns. It's about risk-adjusted returns. So make sure you understand your risk appetite clearly and build a diversified portfolio. Then third very important strategy to handle volatility in stock market is via portfolio rebalancing. While a right asset allocation is very important during your investment journey, it's also equally important to rebalance your portfolio based on market situation at least once in every 6 months. For instance, in last 5 years, while Nifty large cap index has generated around 90-95% return, your mid cap index is up around 200% and small cap index is up around 250 to 300%. As a result, majority of investors have entered into stock market post-COVID, and by the way, a huge number of people have started their investment journey post-COVID, where total number of Demat accounts zoomed from 4 crore during March 20 in COVID to 17 crore now. So majority of new investors ended up building a portfolio of mid and small cap stocks. And that has really worked well so far, because when the economy is in growth phase, mid cap and small cap companies tend to perform better. Moreover, the valuations of mid cap and small cap stocks during COVID were at rock bottom level because of massive correction during 2018 to 20 period. However, today, if you look at the valuation, mid cap index is trading at a PE of around 43-44 as compared to its historical median PE of 27. Please note that there is a 25% jump in mid-cap index after inclusion of Vodafone Idea. So even if we neglect that, mid-cap index is trading at a PE of around 35-36. Likewise, your small-cap index is trading at a PE of 34-35 versus historical median PE of around 29. As compared to that, large-cap index is trading at a PE of 22, which is at par with its historical valuation. Clearly, the valuation in mid-cap and small-cap index are way above their historical median. That's because majority of people are doing SIP in the mid-cap and small-cap sector. So due to huge inflow of funds in mid-cap and small-cap mutual funds, even fund managers have to keep investing that money even at higher valuation. But history suggests that when the stock market valuation are at very high level, it does not end well. So far, the rally in mid and small-cap sector was due to high growth in economy post-COVID plus very attractive valuation. But today, valuations are very rich, and there are also signs of slowdown in the economy. That's why today it's very important to rebalance the portfolio and have a good allocation in large cap as well. Likewise, it's important to book profit from sectors that have rallied a lot and rebalance the portfolio in sectors where risk reward is favorable. I'll give you an example. The electronic sector of India has seen massive growth in last few years, and certainly there's a very bright growth prospect for the sector. But you can't pay any price for growth. Some of the companies in electronic sector are now trading at a PE multiple of 200 to 250. That's crazy. Likewise, today nobody wants private bank, and that's where risk rewards are much favorable for private bank for long term. So it's very important to rebalance portfolio based on risk reward. Likewise, if equity sector has created good wealth in the past, and if there's volatility in the economy or globally, it's worth rebalancing the portfolio and keeping some money in gold or keeping some money in form of cash that can be deployed at the time of correction. Then fourth strategy to manage a portfolio during volatility is by thinking long term. As discussed in first point, over the last 40 years, we have seen many corrections and crashes in the stock market. Yet Sensex has zoomed 145 times in last 38 years. And India is one of the fastest growing economy in the world. We have 145 crore population where 50% of the population is below the age of 25 and 65% population below the age of 35. So every year, many people are joining the workforce and there's a massive consumption market in the country. Yes, we have our own set of challenges, but in spite of all the challenges, we have come a long way in last 20-30 years, and I'm sure we'll go a long way in the next 20-30 years. So you need to have that conviction in the economy. Sure, there will be ups and downs, but that is part of the journey. Today, there are signs of slowdown in the economy, and hence we have seen some correction, but remember that won't last forever. So think long term and don't try to time the market by selling everything and waiting for correction, because timing the stock market is impossible. Yes, you can always sit on some cash when the markets are overheated, but don't take extreme decision. So I would say don't overcomplicate investment. Keep it simple. And one of the best way to invest is via SIP. Just keep investing in a systematic manner and let power of compounding work its magic. While a 13.5% CAGR return does not look very exciting, the fact is in 5 years it grows 1.8 times, 10 years 3.5 times, 20 years 12.5 times, 30 years it grows 45 times. Only thing is it would require patience, which very few people possess. Then fifth strategy is avoid greed. There are people who borrow money to invest in the stock market. Even brokers provide margin trading facility where you can borrow money for a fixed interest to invest in stock market. I think it is a recipe for disaster. One of the most underrated aspect of investment is having a peaceful sleep at night, and that can't happen when you are too greedy. So never take leverage in investment. Also, some people try their luck in futures and options and day trading to make quick money. But even SEBI has published data that more than 90% people end up losing money in futures and options. Do you think you have enough skill to be among less than 10% people who make money in futures and options? Well, I would let you decide. Personally, I always stay away from day trading and futures and options. And yes, always keep an emergency fund. Never invest in the stock market if you need money for the short term. So in this video, we discussed 5 strategies to successfully navigate the market volatility. It includes having a clear understanding of difference between a crash and a correction, diversification, which is your right asset allocation. Then third strategy is rebalancing portfolio time to time. Next is to think long term, and fifth is avoid greed. I'll just close this video with one pro tip. Try to avoid looking at your portfolio 10 times a day, especially during correction, because it amplifies your emotion of fear. Now tell me in the comments which strategy are you using to tackle the volatility in the market. If you find this video useful, hit that like button and share it with your friends. And if you are looking for more such informative content around personal finance and investment, hit that subscribe button. I'll see you next video. Till then, take care.